One week mistake can wipe out weeks of your gains. But this one 5-minute rule can save your account. Risk management is the #1 reason why traders either succeed or fail. And the main reason when it comes to risk management is the stop loss. They don't have a stop loss. And another reason is they don't have a risk plan once they step into it, okay? They don't have it. They just hopping in the trade, not knowing what they risking and what their rewards is. So they just basically guessing, or what you would call gambling. You stay to the end. I give you my risk management plan. So this is the reason why 5 minutes is important, because I feel like with me, it's just right for entry, what to see, where the market is going at the current or present moment. Okay, so look at the as a 5 minute as a good time frame when it comes to entry and looking for an entry. Then also you would like to use that 5 minutes. This is where I use the 5 minutes to set my stop loss using a market structure. Okay, a lot of people like using the price movement ticks. That's fine too. You can do that, but like I said, it's a possibility you can get stop out early and miss a lot of money on the plate. But it's also gonna save you a lot of money too as well. So whatever fits you, figure that. You got to figure that out. With me, it's market structure. So market structure helped me stay in the market, not miss anything, but not lose a lot as well. Okay, or not lose any trades, or how should I say it? It's not lose any trades, but not lose a lot. Like, for example, let's say using the price, the tickers, you might be able to get more money out of that, but you might be able to leave out the trade too early. Where the market structure, you might not get as much if you would have used tickers, but you be able to stay in the trade much better. Okay, you can see it. And market structure is like you basically seeing the builder blocks. And it's like it's easy to predict the market, in my opinion. So that's why I use market structure. And step number 3, you gotta know when you gotta know when to cut it or let it run. A lot of times, the people risk a lot, and then they either give their money back or get a small reward. It's because of the market structure. And I use the 5 minutes to risk very little. Excuse me, you risk very little for a high reward. A lot of times I like risking 25 ticks in order to get 80 ticks. And with using a range breakout, especially lately, I hit that a lot. So that's basically 4 times the money, almost 4 times the money. Okay, sometimes I get 100 ticks, sometimes I get more, but it's how you use it. Especially it can be priced different too. Especially when you do what I say, like enter the when it does the range, when it breaks out the range, you enter with a small lot and wait to see where the market is actually going. If it continue to go your way, you enter a little more. So you might not get exactly the amount that you expect when it comes to ticks, okay? But still, look at the ticks instead of looking at the money. That's very important. Look at the ticks. So I like looking at the ticks, see how the ticks move. So 25, I'm risking 25. Sometimes, a lot of times I get 80 to 100 ticks in reward. That's almost, if not exactly, four times the money. Okay, so this is why it's very important to use the 5 minutes in the market structure, because it helps you risk lower and gain a lot more as well. Okay, and while you're using that to trade your stop, it helps protect your capital gains as well. So all this right here is very good when it comes to risk management. Just comment RM below so I know if you committed to better risk management. Okay.